In today's video, I am going to be breaking down the differences between an ETF and a stock and which one you should buy. Basically, it comes down to risk as well as what you really want to do with your investing. So there's so many different styles and types of ETFs that it could get confusing, and I want to kind of break down those today. And then obviously the stock side, should you buy individual stocks. But first, let's understand what an ETF really is. So basically an ETF, for example, this one is XIC, it's the iShares Core S&P TSX Capped Composite, and this is more or less your average index fund, which an index fund holds essentially the same amount of companies that are in the specific index that you're investing in. So for example, this is the TSX, which is the Canadian stock market, and from there we have Royal Bank number one because the Royal Bank is the biggest company in Canada. Shopify is number two, and depending on when you watch this video, Shopify could be number one. These two companies tend to fight each other all the time for the number one spot. Next is TD, Bank of Nova Scotia, Canadian National Railway, Enbridge, Brookfield Asset Management, Bank of Montreal, CPR, which is Canadian Pacific Railway, or CP on the stock market, that's the ticker, and then CIBC. Now, as you can see, the Canadian index, the Canadian stock market is very heavily in banks as well as in oil. These are kind of the two biggest sectors in Canada. Railways are up there as well, with only one tech stock. Meanwhile, if you looked at something like VOO, which is Vanguard's index of the S&P 500, or SPY, which is another index fund for the S&P 500 down in the States, those two are going to be very heavily into tech because the tech companies are the biggest companies in the world in general, but they are the biggest companies on that stock market. So even though you are investing into an index, basically the market as a whole, you are now at this point investing still specifically in those bigger name stocks, because at that point, like we see here, the banks are a big portion of the Canadian market. Now, when you start seeing the word capped, what that basically means is they cap how much of an individual stock they have in this ETF. Now, the thing about ETFs versus individual stocks is an ETF will have what's called an MER, or an expense ratio. It's the same thing, just different wording essentially. And this one is 0.06%, which basically means if you were to buy $100 worth of this ETF every single year, the company iShares will take 6 cents from your overall investment, which then means that you really want your ETF to go up higher every single year than the MER that it states. Meanwhile, with an individual stock, you're not going to get that. With an individual stock, you don't have to pay an MER. The MER is essentially paid so that now that individual company that's running that ETF gets to pay themselves for spending the time to invest your money. It's essentially paying people to invest your money for you. Now, sometimes something like this or an SPY ETF will essentially just be automatic. It's essentially a computer does it. It weights the stocks for the biggest to the smallest, and it'll invest in however number of stocks that are on that index. Now, when it comes down to it, some ETFs like this one, the iShares XIC index fund, is extremely cheap. It's only 0.06%. You're not going to miss 6 cents for every $100 that you spend, or 60 cents for every $1,000 that you spend, because a stock market in general will go up on average 5 to 8% a year, and you're not going to be missing that 0.06%. So in general, you're not going to have to worry about the MER in an ETF. One thing I do suggest to look at when you buy an ETF or any stock on the stock market is to look at the volume. This is what they call liquidity. It's the ability to get in and out. So if you're looking to buy this ETF and you're looking to buy, let's say, 150,000 shares, if there's only 360,000 shares being traded, then at that point it would be hard to get in and out. But if you're only looking to buy maybe 1,000 of these shares, which would cost you $31,000, then at that point 1,000 shares out of the average is not going to be very hard to buy or even sell. And I really doubt that most of us are going to be buying 1,000 shares of this all at one time. Now, the yield is the next thing that you kind of want to pay attention to if you are a dividend investor like myself. I really like dividends, and this is 2.62%, which is a heck of a lot better than interest. But, for example, if you were to invest $100, you would essentially get paid out $2.62. Now, this yield number does change with the fluctuation of the actual stock price. So if the stock price goes higher, then essentially the yield goes lower. However, at the same time, companies will always be raising their dividends as long as they are profitable. And if they're profitable, they're going to be raising their dividend anyways. And generally speaking, this ETF, not including the COVID crisis when all the stocks went down, this ETF generally sits around 2.5%. So if you're okay with making 2.5% plus whatever the stock or ETF goes up at the same time, then you're all set and you're happy. And as you can see, this does really follow the stock market itself. We can see the 2008 crisis, we can see the COVID crisis, we can see minor issues in between. You're going to have to remember that the market will always have corrections, and you never want to buy here and say, oh yeah, life is great, everything's going up, and then say, oh no, it's the end of the world, I need to sell here. That is something that you never want to do, and what you would like to do is to wait for a small little pullback. Things like this. See this double bottom right there? Anytime that there's a double bottom, that's a prime location to buy. Or you can be like me with these different index funds. I have a few different ones now, and basically what I like to do is to just regularly invest my money. Anytime I have a couple of hundred or a couple of $1,000, I will invest it into a different index so that I can be diverse. And then I do make bigger purchases of single stocks out of the ETFs that I have. I would sell the ETF, and then when I see a good price on an individual stock, I would then go in on that stock. Now, you can go into an individual stock. It's really not that hard. It's the same process as if you were to buy an ETF. However, there is more risks when you look at a single stock. So, of course, there is no MER, so you're saving a lot of money. However, the risk that you're taking here is with an ETF, you're usually going to be holding anywhere from 4 or 5 stocks, upwards of 500 stocks. There is a massive wide gap between the different ETFs, but in general, you're going to be looking at probably 30, 40, 50 stocks in an ETF. Meanwhile, with an individual stock, if it goes down, then you'll definitely see that on your list. However, if a single stock out of 40 goes down, you're not going to see it. So that's why it's a little bit safer to go into ETFs, even though there is that MER cost involved with them. At the same time, if a single stock, for example, here we have Bank of Montreal, if that goes and just explodes to the upside and every other stock in the index doesn't, then you're really not going to see it either. So that's the kind of risk. With an index fund or with an ETF, you're generally going to be sitting in line with wherever those stocks as a whole go. However, with an individual stock, let's say for Tesla, you can literally go to the moon and you'll be all set and happy and I own Tesla stock. I am a huge believer of Tesla. Look into it for yourself, but they're not just a car company. But now I'm getting way off topic. However, as we can see here, this stock, BMO, pays currently 3.28% every single year, and they generally raise their dividend about 5% every single year. So for example, if they were paying a $4 dividend today, and then next year they had good earnings again, and they keep on raising their dividend, then in theory, next year they would be paying about $4.20 per share for the entire year. And the reason why I personally really like Canadian banks is the fact that none of the big 6 banks have lowered or stopped their dividend for well over 100 years. So for me, that's good enough history to say they're fantastic investments. But you can never go by what the history of the stock does to say what's going to happen into the future. But when you start looking at like literally centuries of growth of a dividend and centuries of never stopping a dividend. That's a pretty substantial history to go by. And as you can see, unlike that ETF that I just showed you where it slowly went up during this time, we can see with Bank of Montreal, if you were only invested in that, you would have been trading sideways, only collecting a dividend for almost 4 years. Then COVID hit. We learned that the banks are no longer just working on interest rates to make money. They can make money many different ways. And now they have exploded to the upside. And will this continue? It's hard to say. But when you have almost 4 years of no growth, and then you see massive panic selling, and then you also see massive job losses, and you see all of that, and yet the banks can still make killer numbers, and that's why they're going up. Now, once the interest rates start going up, which is where banks usually go up in price, they're going to be making 2 different sets of income sources, interest rates as well as their monthly fees that they charge. I think that this could run a bit more if interest rates go higher, even though people are not saying that that will happen yet. Historically, every time banks go higher, interest rates go higher, so it's just confusing to me why people are saying that. And we can see over time that, of course, we see single stock risk come up multiple times, especially in 2008, where it basically went from $70 a share all the way down to less than $30, almost $20, which, by the way, fantastic buying opportunity if anyone got that. And then, of course, it took how many years to get back to $70? This is what I mean by single stock risk. Now, I'm not here to scare you about single stock risk, but if we look at the 2008 crisis, 2008-2009, and we see that it went from, this ETF specifically, went from just under 25, so let's call it about $23, $24, all the way down to 12, which is a 50% drop. And then it took 1, 2, and about 2.5 years to return close to that amount. And then it dipped again, and it took all that time until 2014-15 to recover yet again. Even though the BMO stock took that amount of time, this actual ETF recovered much faster, and you could have got out if you were too scared here, rather than waiting all those 7 years to be able to get back out of it. However, at the same time, this is why it's good to put in small amounts all the time, because then you can take those losses, not pay attention to them, and then end up with massive amounts of money at the end of the day. Now, you could get into an ETF called the BMO Equal Weight Banks Index ETF. This one to me is not a great investment. You could just invest into the banks individually themselves at the rate that you would like, because this charges a 0.6% MER, which means for every $100 you're then giving away 60 cents. But this is the big thing about this one. You really have to look at ETFs and what they hold, because as we can see here, they hold literally 6 stocks. It's the big 6 banks in Canada. Now, of course, you can look at these ETFs and say, well, okay, Bank of Montreal is currently 17%. Can I make my own portfolio buying the same exact stocks at the same percentage? Or do what I do, which is, well, you know what? Right now, it looks to me that Bank of Nova Scotia is a very expensive PE stock, and PE ratio and price to earnings, and each bank has that. And that's something else that's a little bit more advanced than what I want to talk about in this video, but I'm going to talk about that in a later video, and if I have already, then I'll mark it up top. But from there, you can say, well, Bank of Nova Scotia has a higher dividend. I want to go for a higher dividend, even though they're a higher, more expensive stock. Well, you know what? Maybe I'll put that up here. And national banks had some big growth recently, so I'll stick that as number 1. I'll stick Bank of Nova Scotia number 2. You can basically make your own ETF at this point and not charge a 0.6% MER. Because I can tell you right now, this period right here is something that the banks averaged across the board. However, National Bank didn't average that, and it was going up during this time, and I was a big buyer during this time of National Bank because it was going up and not trading sideways. And that's basically my message for that, is just watch out what you actually are investing in with ETFs, see what it's holding. If it's charging you an obscene amount of MER and it's really only holding a few shares, just buy the shares instead of the ETF. And then that way you can make your own ETF and make it where you want it to be. So if you think that National Bank's going to be continuing to go up, let's say 3 years ago, you could have been 50% of your portfolio in National Bank and 25% in TD, and then the rest are just smaller. Things like that. And that's essentially what I was for the longest while. I had most of my money in National Bank, and it was going up during that time because it was going up. And that's why I did it. But just really quickly, PE ratio, Bank of Nova Scotia is 12.79 at this point in time. Because of their earnings, they've actually, that number's moved down. It was in the 13, 14 range earlier in this year. And its dividend yield is 4.45%. So, for example, you'd be able to make $4.45 for every $100 that you invest. This is what I mean by, if you want a higher dividend, then you can just go to the individual stocks or whatever that have the higher dividend. But at the same time, during that sideways trading time, Scotiabank, Bank of Nova Scotia, was actually having a downtrend. So, of course, there's always trade-offs. This would have been an interesting time to buy all the way down. I was starting to buy Scotiabank around here when it was trading sideways after all of this downturn, because I knew that Scotiabank had one of the higher dividends and they have been hurting for a very long time. And my thesis with the Canadian banks, even though this video is not about the Canadian banks, my thesis with the Canadian banks is the fact that you buy the ones that are hurting when it comes to the big six, because eventually they are going to be turned around, and then they will be the ones that are favored on the stock market, and that's just essentially, it's a cycle. It's like it seems to be a 10 to 15 year cycle, and if you're looking to invest in that period of time, then that's kind of a good mindset to be on. Now, there's different types of ETFs, and I'm going to show you two different types right now. First off is the covered call ETF, and this is why I'm mentioning this is because you can get massive dividends on covered call ETFs. This one specifically pays 6.28%. It's ZWH. It's the BMO US High Dividend Covered Call ETF. And from there, what you want to see on covered call ETFs, I'll tell you right now, is if you go to like a max or a 5-year chart, you want to see upwards trends. You never want to see a covered call ETF going down negative as long as the index that it's currently covering also is going down. And in that case, you'd be okay. But when you're looking at a covered call ETF, you really want to see an upwards trajectory. And the reason for that is the fact that now, with covered call ETFs, some companies, some ETFs will run it a bit differently. So what is a covered call? And of course, why does a covered call get a higher dividend? Well, for example, this one does hold Bank of America, Home Depot, Microsoft, Cisco, IBM, JP Morgan, AbbVie, AT&T, Apple, and Pfizer. Now, that's 40% of all of the stocks that they hold. However, with these stocks, they essentially, let's say they had 100 shares. And what I've read about BMO covered call ETFs is they would sell, if for every 100 shares that they have, they would sell call options on 10 of them, about 10%. Now, without getting into the whole price structure of call options, options are basically betting for the stock price to go up, and you can pay a premium to take that bet, to be able to buy the stock at today's price and then promise to buy it at today's price into the future. And then you pay a premium. Now, if that price, let's say Bank of America, you buy a call option for the price to hit $40, and it never hits $40, but you paid, let's say, $120 for a promise to buy 100 shares. Well, if it never hits 40, you lose that 120. You don't buy the shares, so you don't have to worry about paying that much money for the in this case it would be $4,000 for 100 shares. You would just have risked $120. And of course, that premium that I just mentioned, that 120, would then be put into a dividend for you, which in this case equals 6 point something percent. Meanwhile, there's other ETFs like Horizons Marijuana Life Sciences that pays a 3.3% dividend, as we see right there, and none of these stocks, I think only one in the whole portfolio, pays a dividend. So why would this pay a dividend when the stocks themselves don't pay a dividend and it's not doing a call option type of structure? So basically what this one does, and you really have to read into the ETFs. This is why I say you really need to read into the ETFs and understand each one, is because this one actually gets its yield by borrowing out its stock so that the stock could be shorted. And basically, what is a short stock? It's basically, let's say I wanted to short a stock, I would borrow, let's say, a share from Apple, or a share from somebody who owns an Apple share, and then I would sell it without even owning it. I pay that person an interest for me to do that, and then what I'm hoping for is that stock to go down in price so that now I can buy it back at a lower price. Let's say I sold it at 100, I buy it back at 90, I keep the 10, I give the stock back, and then I might pay, let's say, a 5% interest, which would be maybe $5 to that person, and then I get to keep the $5 and I'm all happy. It's a really risky trade, but you can profit off of that type of stuff by buying that ETF. That ETF is HMMJ, for those who are wondering the ticker. Anyways, this is the differences between ETFs and stocks. ETFs give you a couple of different options or ways to trade, while stocks, you can short them yourself. I would suggest not to, but you can buy them, hold them, basically flip them a day later, it doesn't matter. While with an ETF you can do the same thing, but there's some different ways that each ETF really does work. So it's kind of interesting. I hope this video has helped you. If it has, hit that like button, subscribe. I'll see you guys again next time.